Happy Monday, everybody. Today is March 23rd, 2026, and this is your Monday market update. Now, I hope you had a great weekend. Now, remember, there are weeks where markets are driven by earnings. There are weeks when they're driven by the Fed. And then there are weeks like last week, and it seems this week too, where everything runs through one variable, oil, and more specifically, what's happening in the Middle East. Because as we saw all week long, and it looks like we're going to carry that into this week, as oil goes, so goes stocks. Let's look back at the markets. Let's recap last week and let's preview this week. We started the week on Monday with a strong rebound, and importantly, that rebound was directly tied to a pullback in oil prices. There was no major escalation in the Iran conflict over the weekend, and we actually saw some normalization in tanker traffic through the Strait of Hormuz, which helped calm energy markets. Now, that triggered a sharp move lower in crude and a strong move higher in equities. Commentary from Treasury Secretary Bessent reinforced that dynamic, and the creation and the reaction confirmed what we've been saying is that this market is trading oil first, everything else second. Tech added some fuel to the rally with NVIDIA's conference and Meta moving higher on AI-related developments. And importantly, participation was broad with all sectors higher. By the close, the Dow was up just under 1%, the S&P 500 up about 1%, and the NASDAQ was up 1.25%. Tuesday started the same way with another strong open and continued resilience in equities, but underneath the surface, the tone was already beginning to shift. Oil prices resumed their climb, and as the day went on, stocks slowly gave back a portion of those early gains. You could feel investors getting more cautious ahead of the Fed decision, and that combination, rising oils and Fed uncertainty, kept a lid on the rally. There were still bright spots with Qualcomm moving higher on capital return announcements and Delta rallying on strong demand, but the broader takeaway was clear. This market struggles to rally when oil is rising. By the close, the Dow was up about 0.1%, S&P 500 up about 0.25%, and the NASDAQ was up just under 0.5%. Wednesday was the turning point. Markets opened lower as oil spiked again overnight following renewed attacks on the energy infrastructure in the region. At the same time, we got a hotter than expected PPI report, reinforcing inflation concerns. Then came the Fed. The Fed held rates steady and importantly kept the expectation of one rate cut intact. But Powell acknowledged that progress on inflation has been slower than he hoped. That was enough to trigger a broad risk-off move. All sectors finished lower, which tells you this wasn't isolated. It was systemic de-risking. By the close, the Dow was down about 1.5%, S&P down about 1.33%, and the NASDAQ was down about 1.5%. Thursday perfectly captured the market environment we're in right now. Stocks opened lower again as oil surged overnight after another escalation, including a strike on a key LNG facility in Qatar. That drove a classic risk-off trade with only energy holding up early. But then headlines flipped. Comments suggesting the conflict could end sooner than expected sent oil sharply lower, stocks sharply higher in the afternoon, and yet that rally didn't hold. Markets faded into the close, reinforcing just how fragile confidence is right now. By the close, the Dow was down about 0.5%, S&P down about 0.25%, and the NASDAQ was down about 0.25%. Friday continued that same pattern. Escalation headlines picked back up. Oil moved higher again, and with it came renewed inflation concerns and pressure on equities. Selling was broad, and the market indexes briefly dipped toward correction territory before stabilizing slightly into the close. By the close, the Dow was down just under 1%, S&P 500 down about 1.5%, the NASDAQ was down about 2%. When you zoom out, the story is clear. Early week gains were driven by falling oil. They were reversed as oil surged again. Inflation data surprised the upside, and the Fed reinforced a higher for longer stance. For the week, the Dow was down about 2.25%, S&P down about 2%, and the NASDAQ was down just over 2%. Now that's 4 consecutive weeks of losses. Now let's look ahead into this week, and this is where we layer in some additional detail that really matters, especially around Fed communication. We do get some important economic data, including productivity and labor cost revisions early in the week, import and export prices midweek, and consumer sentiment on Friday, which is going to be closely watched for any signs that higher gas prices and geopolitical tensions are impacting the consumer. But more importantly, this is a heavy week for Fed speakers, and in this environment, Fed messaging does matter just as much as the data. So we're going to hear from Governor Moran multiple times this week. Now, that includes early today, and his recent comments are notable. He has suggested that 4 rate cuts in 2026 could be appropriate and that the labor market may need more support. That's more dovish than what the market has been pricing for sure. Governor Barr speaks as well, and his tone has been more cautious, emphasizing that rates may need to stay steady for some time, given the delicate balance in the labor market. Governor Cook will also speak, and she has been very focused on inflation, specifically noting that progress has stalled and reinforcing the importance of maintaining credibility on inflation. We'll also hear from Vice President Jefferson, who has struck a more balanced tone, cautiously optimistic on growth while still watching inflation closely. Rounding out the week, Fed President Daly and Philadelphia Fed President Paulson will provide additional commentary, both emphasizing the dual mandate challenge right now, watching inflation while also monitoring the labor markets. So the takeaway is this: the Fed is not united. You have dovish voices pointed to labor market softness, more cautious voices emphasizing patience, and inflation-focused voices warning that progress is stalled. That divergence is important because it adds to uncertainty around the path of rates. And all of that is happening against a backdrop of rising oil prices, which complicates the inflation picture even further. Final thought for today. This is one of those environments where the day-to-day moves feel very reactive. Oil up, markets down. Oil down, markets up. Headlines driving everything. But zoom out for a moment, and this is a market trying to find equilibrium between growth, inflation, and policy. That process is never smooth. Volatility is not a signal that something is broken. It's a signal that markets are adjusting. And in times like this, the most important thing is not reacting to every headline, staying anchored to a disciplined plan. As we start today, an early morning post from the president has given markets, if nothing else, a glimmer of hope for brighter days, at least early. Stay tuned. We'll see what happens. More importantly, stay focused on your long-term goals and keep planning. Have a great week.